Welcome to the deep dive. This is where we take, just stacks of information, all of the latest reports, research, our notes, and really boil it down to those key insights, those golden nuggets you need to, actually feel well informed. Have you ever found yourself, maybe late at night, scrolling through real estate listings? You kind of sense something shifting in the market, right?
Yeah.
But it's hard to put your finger on the full picture.
Yeah, or you see the headlines, right? All these complex real estate news stories, and you're trying to figure out, okay, what does this actually mean for me?
Exactly. Whether you're thinking about buying or maybe selling, or honestly, even if you're just curious about how this city works, how Austin ticks.
It's a feeling we hear all the time. I mean, let's be honest, real estate news can be overwhelming. It's full of numbers, jargon. It doesn't always translate easily into, practical understanding.
Or what you should do about it.
Right. You see the data point, but the so what is often missing. And that's really why we're here, to try and bridge that gap.
And today, we are taking a really deep dive into the Austin real estate market. We've got the latest weekly update, hot off the press, for July 3rd, 2025.
Fresh data.
Fresh data. And our mission today, it's pretty clear. We want to cut through all that noise. We've got comprehensive, data-driven reports right here in front of us. And we're going to extract the most important facts, maybe some surprising insights, and definitely the clear implications for you.
Essentially, give you a shortcut.
Yeah, a shortcut to being genuinely well-informed about what's truly happening on the ground here in Austin real estate. Just enough clarity, enough detail to really empower your understanding, whether you're that buyer looking for a dream home or a seller planning your next move.
Or someone who likes to know what's going on.
Exactly, someone who appreciates understanding the mechanics of the city's economy.
Think of it like peeling back the layers of an onion, maybe. We're not just going to throw numbers at you.
Yeah.
We want to give you the why behind the what.
Right. So you can navigate this, let's face it, complex market with a bit more confidence.
Yeah, and a much clearer sense of direction, hopefully.
All right, let's dive in. Let's unpack this. Our first big topic, segment 1 here, is focusing on what feels like a really fundamental shift in Austin's real estate landscape. It's the undeniable rise of inventory.
Yeah, that's the headline, isn't it?
It really is. For years, it felt like the constant story was low inventory, driving prices up, up, up. But the data now, it's telling a very different story.
That's a crucial observation. The Austin Area Multiple Listing Service, the MLS, it's definitively in a significant market transition phase, no question about it.
And what's driving that transition?
More than anything else, it's the consistent, steady increase in the number of homes available for sale. This expansion of supply, it's fundamentally reshaping the market conditions.
How so?
Well, it's moving us away from those, superheated sellers markets we kind of got used to.
Where houses sold in like an hour?
Pretty much.
Yeah.
Away from that, towards a more neutral environment. And honestly, increasingly, it's becoming more favorable to buyers.
Okay, and the numbers back this up. You've got the latest figures right there.
Oh, absolutely. As of this week, July 3rd, 2025, we're looking at 17,679 active residential listings across the entire Austin area MLS.
17,679. That sounds like a big number. How does that compare?
It is a big number. And maybe more importantly, it's a notable 9.6% increase in available homes compared to the same time last year.
Wow, almost 10% more homes on the market than just a year ago.
Exactly. Think about it like, go to the grocery store and suddenly finding 10% more options on the shelves for something that used to be really scarce. That's kind of the increase in choice buyers are seeing right now.
Okay, more homes, more choices. That makes sense for buyers. But what does it mean for the market's overall, speed or its underlying health? That brings us to months of inventory, right? MOI.
Precisely. Months of inventory, or MOI. It's not just another number. It really is like taking the market's pulse. It tells us how quickly homes are selling relative to how many are actually available.
Okay, break that down for us. How does it work?
So imagine if starting today, no new homes came onto the market at all. The MOI tells you how many months it would take to sell every single currently active listing at the current pace of sales.
Gotcha. And why is that specific number so critical?
Because it gives us a benchmark for market balance. Traditionally, anything under 5 months of inventory, that screams seller's market. Frantic pace, buyers scrambling over each other.
Right.
Anything over 7 months, and you're generally considered to be in buyer's territory. Buyers clearly have the upper hand, more negotiating power.
Okay, so where does Austin stand right now with this 17,000 plus inventory? What's the MOI?
For the entire Austin area MLS, The months of inventory has expanded to 6.39 months.
6.39, so right in that middle zone.
Exactly. It puts us squarely in that 5 to 7 month balanced market range. But crucially, it's definitely drifting towards the higher end of that range, leaning noticeably towards favoring buyers.
And how does that compare year over year?
That 6.39 months marks a significant 16.0% rise in MOI compared to last year. 16%.
Yeah.
Yeah, this isn't just a small fluctuation. It's a clear, sustained trend. More homes are sitting on the market longer, or at least the rate of sales isn't keeping up with the new listings coming on.
Okay, let's unpack that. For the listener out there, maybe someone who felt totally priced out a couple of years ago, or just overwhelmed by how few options there were.
Or defeated by those insane bidding wars.
Exactly.
Yeah.
What fundamental opportunities does this new landscape, this higher inventory, actually present for their search? This sounds like it could be a real game changer.
It absolutely is.
Yeah.
For buyers, these rising inventory numbers, this higher MOI, it fundamentally means more choices. And critically, it means more time.
Time. How so?
Well, the days of feeling like you had to make an offer sight unseen or waive every single contingency just to have a prayer, those are largely behind us now.
Okay.
Buyers now have more breathing room. You can take your time, consider your options more carefully, maybe go back for a second look. You can conduct thorough inspections without that intense pressure. You can actually do your due diligence.
Less fear of missing out instantly.
Precisely. And there are fewer intense bidding wars.
Mm-hmm.
Significantly increased negotiating room. This is a profound shift from just a couple of years ago when properties vanished in days, sometimes hours.
Right.
Imagine going from that frantic sprint where you felt like you had seconds to decide to more of a thoughtful stroll. You can actually negotiate on things like inspection repairs, or maybe ask for closing cost credits from the seller, or even negotiate a rate buy down.
Things that were almost unheard of at the peak.
Exactly. Almost impossible then and now. Becoming much more common, especially in certain price points we'll get into.
Okay, that paints a really clear picture for buyers. More choice, more time, more power. But flip that coin. For sellers, how does this evolving environment, this rising inventory, force them to rethink their strategy? It sounds like it's not just stick a sign in the yard and wait anymore.
Definitely not. For sellers, it implies a clear shift towards significantly greater competition. Plain and simple. Meaning, with more homes on the market, buyers have the luxury, and they will exercise it, of comparing properties much more thoroughly. They'll visit multiple options. They'll be far more selective.
So sellers need to stand out.
They absolutely do.
Okay.
Which means sellers now need to be much more strategic about their pricing, right, from day one.
Yeah.
Overpricing a home in this environment, it's almost guaranteed to lead to it sitting on the market longer.
Which isn't good.
No, because that often requires not just one, but potentially multiple price reductions down the line. And that can signal weakness to buyers, potentially leading to even lower offers.
Right.
And beyond pricing, presentation becomes even more critical. Staging, professional photography, making sure the home shows its absolute best. These things matter more when buyers have more options to compare against.
So it's not just about existing anymore, it's about having exceptional appeal.
Exactly. It's about being competitive, being realistic, and capturing the attention of a buyer who genuinely has choices. This isn't a market that rewards complacency from sellers. It demands careful thought, proactive strategy, and a real understanding of what's happening now.
Less sprint, more marathon for sellers maybe, a more deliberate pace where strategy really pays off.
That's a good way to put it. Strategy is key.
Okay, speaking of strategy and deliberate pace, let's zoom in a bit. Let's narrow our focus from the broad Austin area MLS down to just within the city of Austin limits. What's really interesting here, it seems, is that these inventory trends we just talked about, they seem to be even more pronounced when we look specifically at the city itself.
That's a crucial point, yeah. And it highlights one of the key nuances in the current market. The transition we're seeing isn't perfectly uniform across the entire metro area. It's particularly amplified right within Austin proper.
Amplified how? What does that mean on the ground?
It means the shifts we're describing, the increase in choices for buyers, the growing buyer leverage, they're even more evident right in the heart of the city. You know, where demand has traditionally been the absolute highest and where competition was historically just incredibly fierce.
And the data confirms this amplification. What are the specific numbers for active listings inside Austin city limits? Do they really show that big a change?
They really do. The numbers are quite compelling. Within Austin city limits, active listings have surged by a striking 14.2% year over year.
14.2%.
Yeah. reaching 5,701 homes currently listed. That's up significantly from 4,993 homes just 1 year prior.
Wow. That's not just a small increase. That's a substantial jump in available properties right in the city core.
It really is. It means buyers looking specifically within the city now have a vastly expanded pool of homes to consider compared to just 12 months ago.
Okay, and what about the months of inventory, the MOI, specifically for the city of Austin? Does that metric also show this amplified shift towards buyers?
It does, even more so, arguably. Austin City's MOI has climbed from 6.06 months last year to 6.97 months now.
Almost 7 months.
Almost 7 months. That's a 15.1% increase year over year. So this data strongly reinforces that transition towards a neutral and really leaning toward buyer environment specifically within the city.
Which confirms that growing leverage for buyers looking inside Austin.
Absolutely. You really have more breathing room to make those deliberate, well-informed decisions rather than feeling like you're constantly rushed or pressured.
Okay, now here's where, for me, it gets really interesting. When we pivot from inventory to look at pricing within Austin proper, we seem to uncover this, well, almost captivating split market dynamic. It's not just prices up or prices down across the board, is it?
No, not at all. It's much more nuanced than that. Different segments of the market, different price points are experiencing really distinct and sometimes even opposing pressures.
Okay, walk us through these pricing dynamics. What's happening?
Absolutely.
Yeah.
It really is like a tale of two Austins price-wise. On one hand, if you look at the average list price of active homes within the city limits,
Okay,
the average list price actually increased by 2.5% year over year. It climbed from roughly $795,000, $794,155 to about $815,000, $814,570.
So the average asking price went up. What does that suggest?
It suggests continued confidence, maybe even resilience, particularly at the upper end of the market. Luxury properties, higher-priced homes, they seem to be holding their value, maybe even seeing slight gains in asking prices.
Why would that be?
Well, buyers in that segment are often less sensitive to interest rate fluctuations, right? They might be bringing more cash to the deal. They're often focused on very specific features, prime locations. Maybe they're just shrugging off some of the wider economic jitters more easily.
Okay, so the high-end market seems pretty robust, almost operating in its own little microclimate. But then the median list price tells a very different story, doesn't it?
It absolutely does. And this is where the market's underlying pressures become much more visible for, frankly, the majority of potential buyers. The median list price, that middle point where half the homes are priced above and half below, actually declined slightly by 0.4%. It went from about $601,544 down to $599,000.
Okay, so average list price up, median list price slightly down. What about actual sold prices? What happened there?
Same pattern, essentially. The average sold price posted a 2.1% gain year over year, rising from about $767,000, $766,633 to $783,103,000.
Let me guess, the median sold price went down.
You got it. The median sold price declined by 2.2%, dropping from roughly $600,599,950 down to $586,500.
Okay, that's quite a contrast. Average prices, both list and sold, are up. Median prices, both list and sold, are down. What does that fundamentally mean for someone trying to navigate this market, especially if they're not shopping for, multi-million-dollar estates?
This divergence is really critical for you, the listener, to understand. The increase in the average prices, that's being pulled up by the sales of fewer but much higher priced properties.
The luxury end.
Exactly. It points to continued strong demand, or at least willingness to pay, for properties in those luxury and upper tier segments. Like we said, maybe less reliance on financing, less rate sensitivity.
But the decline in the median prices, that seems like the real story for most people, and maybe for the overall health of the market.
Precisely. That decline in the median price, both for what sellers are asking and what homes are actually selling for, clearly underscores significant price compression right in the middle tiers of the market.
Price compression, what do you mean by that?
Imagine like a bell curve of Austin home prices. The very top end, the luxury peak, that's still holding strong, pulling the average up. But the big, broad middle section of that curve, where most people are buying and selling that part, is getting squeezed downwards, compressed. This means that homes priced near that $600,000 mark, which, let's face it, is a key affordability threshold for a lot of buyers in Austin.
For sure.
That segment is experiencing very visible downward pressure. This is where the bulk of market activity often happens, where families are looking for their primary home, and where buyers are most sensitive to overall costs, especially the impact of current mortgage rates on their monthly payments.
So sellers in that range are having to adjust more.
Absolutely.
Yeah.
Sellers in that mid-tier bracket are finding they need to adjust their prices more often to meet the market, to find willing buyers, and negotiations in that segment are much tighter, much tougher than they were back at the peak.
So bottom line for the listener, what does this nuanced split mean for your specific price point? If you're aiming for that, say, $600,000 sweet spot in Austin,
Right.
you might actually find you have more negotiation power than you'd expect, right? Even within the city limits, and despite maybe seeing headlines about average prices rising.
That's exactly right. It sounds like a very strong signal for buyers active in that mid-tier range.
Right. And it highlights the need to look beyond the averages.
It absolutely emphasizes the need for a granular understanding. Austin isn't just one single market. It's really a collection of these micro markets defined by price point, location, property type. And this data clearly highlights that split.
So buyers in the middle should feel more empowered to negotiate.
They absolutely should. And for sellers in that segment, it's a clear call to be realistic, price strategically right from the start, and make sure your property truly stands out from the increased competition.
Okay, let's pull the lens back out again. Let's broaden our view from just the city to the entire Austin area MLS. Talk about the broader price movements across the whole region, and then let's bring in that, well, ever important factor, the mortgage rate environment. It sounds like the wider market is also doing a bit of this delicate balancing act we saw in the city.
Indeed it is. Across the broader Austin real estate market, we're seeing a very similar kind of delicate balancing act. It's this tension between, buyer caution on one side, driven by affordability and rates, and maybe some lingering seller confidence or expectations on the other.
In the overall picture.
The overall picture suggests stability, but definitely with these pockets of softness, especially noticeable in certain price ranges and maybe certain types of properties.
And the data for the whole MLS supports this. What are we seeing for average and median prices across the entire region? How does that compare to what we just discussed for Austin proper?
It tells a similar, though slightly less dramatic, story. For the whole Austin area MLS, the average list price for active homes is currently $591,864. That's up, but only modestly 1.76% compared to last year.
Okay, a slight increase in average asking price. What about the median?
The median list price across the MLS is virtually unchanged. It's down just 0.02%, basically flat, at $449,900.
Okay, so average asking price up slightly, median asking price flat. What about actual sold prices across the MLS?
Similar pattern again. The average sold price ticked up 1.7% year over year to $572,571.
The median sold price softened.
Exactly. The median sold price across the entire MLS softened slightly, declining 1.1% to $435,000.
So it really is a consistent theme, isn't it?
Yep.
Average prices showing some resilience, probably helped by those higher end sales. While the median prices, the midpoint, are showing a bit of a dip or stagnation. What's the takeaway there for the wider market?
Well, this dynamic consistently underscores that even while those upper tier properties are helping to buoy the overall average prices across the broader MLS.
Right.
The consistent softening, or at least flattening, of the median prices points to ongoing significant pressure right in the middle market and also the entry-level segment.
Because of affordability.
Primarily, yes. For many buyers, especially those who rely heavily on financing and are looking for those more attainable price points, affordability remains the top concern, maybe the top concern. And that directly influences overall pricing dynamics. It creates this persistent downward pressure, or at least resistance to upward movement in those key high-volume segments.
So it's a clear signal that even if some parts of the market are strong, we're not seeing appreciation across the board.
Definitely not universal appreciation. And it really hammers home the importance, again, of looking past those headline average numbers and understanding the specific dynamics of the price point you are interested in, whether you're buying or selling.
That's a crucial distinction for the listener. And speaking of price levels, how do these current figures, even the slightly higher averages, compare to the absolute peak of the market, back in the frenzy of early 2022? Because it still feels like prices are way off those highs.
You're absolutely right to feel that way, and the data confirms it. Despite some of this recent stabilization, maybe even slight gains in average prices in some reports, the overall market remains significantly below its peak values from a couple of years ago.
How far below?
The Austin Round Rock Georgetown, Texas metro area is currently down a full 15.0% from its peak, which occurred back in May 2022.
15%. Wow. That's not just a dip. That's a substantial correction.
It's a very substantial correction, especially for a market that was not that long ago, touted as one of the hottest, if not the hottest, in the entire country.
How does that 15% drop compare to other markets around the U.S. that have seen corrections? Does it put Austin in a particular category?
It definitely does. It places Austin squarely among those cities that have experienced the more significant drops from their peaks nationwide. For a bit of context, look at places like Punta Gorda, Florida, that peaked in July 22. It's down 13.3%. Or Cape Coral, Fort Myers, Florida, also peaked July 22, down 11.9%. So Austin's 15% drop is right up there with some of the most notable corrections we've seen.
So if you're someone who's been sitting on the sidelines, maybe feeling like you missed the boat, or you're just trying to get your head around how today compares to that crazy frenzy of 2022.
Yeah.
That 15% drop from the peak is a really key figure to keep in mind. It signifies a major recalibration has already happened.
That absolutely does. A fundamental recalibration.
Okay, that puts prices in perspective. Now, we really can't have this conversation without talking about mortgage rates. They've been arguably the single biggest factor, maybe a true force majeure, shaping buyer behavior and just overall market activity for the past couple of years. What's the current landscape looking like there?
You're right. They are profoundly significant. Mortgage rates continue to be a major driving force in these market dynamics. They directly influence affordability, they impact purchasing power, and ultimately they shape buyer behavior.
So what's the number right now? As of early July 2025.
As of July 3rd, 2025, the current average 30-year fixed mortgage rate, according to Fannie Mae, is sitting at 6.77%.
6.77. And how does that compare to, say, the month before? Slightly lower, actually. The average for June was 6.82%. So a small dip, but still hovering right around that high 6% range. These are the numbers that today's buyers are plugging into their calculators when they figure out their potential monthly payments.
And how do these current rates stack up historically? I mean, it certainly feels high compared to the very recent past, right? Those pandemic lows everyone talks about.
Absolutely. Compared to the recent past, they are significantly higher. If you look back at the exceptionally low rate environment of 2020, 2021, I mean, the average rate for all of 2021 was just 3.09%.
Wow, 3%.
Yeah.
Feels like a lifetime ago.
Doesn't it? That period was really an anomaly, though, driven by some pretty unprecedented economic conditions. Even compared to the 2022 average, which was 5.31%, or the 2023 average of 6.82%, today's rates are certainly elevated from what many buyers who enter the market recently might be accustomed to.
But what about the longer view? Before the pandemic craziness.
That's the crucial context, and it's often missed. This current rate of 6.77%, it's actually below the overall historical average rate since 1971. Really, what's the long-term average?
The average 30-year fixed rate since 1971 is 7.71%.
So we're actually below the long-term average right now.
We are. So while, yes, it's much, much higher than those record lows of 2021, which definitely distorted expectations for a lot of people.
For sure.
It's not historically extreme when you look at the bigger picture over decades. It's maybe more of a return to a normal, albeit challenging, rate environment.
That's a really important dose of perspective. Okay, so given these rates, around 6.8%, how are they fundamentally impacting purchasing power and those monthly payments for today's buyers? What's the real hit to the wallet?
The impact is substantial, no question. A higher rate means a significantly larger chunk of your monthly payment goes towards paying interest, especially in the early years of the loan, rather than actually building equity by paying down the principal balance. And what that does, in turn, is it either reduces the amount of home you can afford for the same desired monthly payment, or it simply makes the overall cost of financing that home much higher over the 30-year term.
Which naturally makes buyers more cautious.
Exactly. It leads to more cautious buyer behavior. Many potential buyers are finding they really have to stretch their budgets to meet these new payment realities, or they have to adjust their expectations downwards in terms of home size or location.
And how is buyer sentiment reflecting this? Do people expect rates to come down soon?
That's interesting. The Fannie Mae Home Purchase Sentiment Index, the HPSI, for May 2025, it sits at 73.5. That index gives us a snapshot of how consumers feel about the housing market overall.
Okay.
What's particularly telling within that index is that only 29% of the people surveyed said they expect mortgage rates to go down in the next year.
Only 29%. So most people think these rates are sticking around.
It suggests a pretty widespread acceptance, or at least resignation, that these higher rates might be the new normal, at least for the foreseeable future. And that sentiment, that expectation, it translates directly into more hesitant buyer behavior and continued pressure on affordability as buyers kind of adapt and adjust to this financial reality.
So even if rates aren't historically through the roof compared to the 70s or 80s, the perception and, more importantly, the very real impact on affordability today is a critical factor. It's profoundly influencing buyer decisions.
Precisely. It keeps affordability right at the forefront of nearly every potential home transaction, and it's forcing that constant recalibration of what buyers can realistically afford and maybe even what sellers can realistically expect to get.
Okay, let's move beyond just the raw numbers of listings and prices. What are some of the key health indicators telling us about Austin's market right now? Let's try and decode some of that crucial data that helps us understand the market's true balance and maybe its underlying dynamics. Let's start with months of inventory MOI. We touched on it earlier, but let's really dive into its meaning as a market balance barometer.
Yeah, the months of inventory MOI, it really is one of the most critical metrics we have for gauging that balance of power, that leverage dynamic between buyers and sellers.
So just to recap, how is it calculated again?
Right. It's simply the estimated time in months that it would take to sell all the currently active listings on the market.
Okay.
At the current rate of sales, if no new homes were added to the market. Think of it like draining a bathtub. MOI tells you how long it would take for all the water to drain out if you turned off the tap, given how fast the water is currently going down the drain.
That's a good analogy. And how do we interpret that number? What are the practical thresholds for seller's market balanced, buyer's market using MOI?
Generally speaking, the rule of thumb is less than 5 months of inventory typically indicates a seller's market. Demand is significantly outpacing supply. Homes sell fast, often with multiple offers.
Right, the frenzy.
Yeah. There you have the range of 5 to 7 months, which usually suggests a more balanced market. Neither buyers nor sellers have a huge advantage. The market moves at a more moderate, predictable pace. And then, once you get above 7 months of inventory, that typically signals a buyer's market. There's an abundance of homes relative to demand, giving buyers substantial leverage, more time to choose, and greater power to negotiate.
So where does Austin fall right now on that spectrum? You gave us the numbers earlier.
Right. Currently, Austin's overall MOI for the entire Austin area MLS is 6.37 months.
6.37.
And maybe more telling, when we drill down specifically within the city of Austin limits, that number is higher. It's 6.97 months.
Wow, almost exactly 7 months within the city itself.
Right on the cusp. So what does this all mean? Well, these figures clearly position the Austin market overall squarely in that balanced range. But with the MLS at 6.37 and the city nearing 7 months, there's a definite pronounced lean towards it becoming a buyer's market, especially when you focus on properties inside the city limits.
So it strongly confirms that narrative we've been building.
Absolutely. It confirms the market is distinctly cooling, buyers are systematically gaining negotiating power, and they're finding themselves in a much more advantageous position than they've been in for years. It's not just a slight tweak, it's a fundamental rebalancing of that power dynamic.
Okay, next up, let's look at the absorption rate. Sometimes you hear it called the sold to active ratio. So we know there's more inventory, but inventory volume alone doesn't tell the whole story, right? What about the pace? How quickly are these homes actually finding buyers and being absorbed from the available supply?
Right, the absorption rate is a direct and really vital measure of demand relative to the current supply. It's essentially the proportion or percentage of active listings that actually sell within a given period, usually calculated monthly.
So a higher rate means faster sales.
Exactly. A higher absorption rate means homes are being absorbed more quickly off the market, indicating a faster moving market with more robust demand. For Austin proper, the overall absorption rate is currently sitting at 18%.
18%. How does that compare? What do these percentages typically signify for market speed? Is 18% fast, slow, average?
Well, generally, a high ratio, typically above 20%, implies a strong seller's market.
Okay.
Homes are moving very quickly, almost as soon as they hit the market.
Okay.
Conversely, a low ratio, say below 10%, suggests a sluggish market, one that heavily favors buyers, where homes tend to linger on the market for quite a while.
So where does Austin's 18% fit in?
Austin's 18% indicates moderate demand. It's definitely not that red-hot above 20% pace we saw at the peak seller's market.
Right.
But it's certainly not stagnant or sluggish either. It's not below 10%. It suggests a market that's active, but not frenetic.
Meaning serious buyers are still out there.
Yeah, I mean, serious buyers are still actively looking and buying, but they clearly have the luxury of choice now, and they aren't acting with that same sense of extreme urgency they had before. They can be more deliberate.
And does this absorption rate, this 18% overall for Austin, Does it vary much by price range? Can you give us a couple of examples? Because that could make a big difference for individual buyers and sellers depending on their bracket.
Oh, it absolutely varies. And this again highlights those micro market dynamics we keep talking about.
Okay.
So for example, if you look at homes priced between $700,000 and $800,000 right now in Austin, the absorption rate is actually 21%.
21%. So slightly stronger demand in that specific slice.
Exactly. It suggests slightly stronger demand, maybe a bit more competition in that specific upper mid-tier segment, perhaps where certain affluent buyers are still competing for premium properties in desirable locations.
Okay, interesting. What about the really high end, over $1 million?
That's where it drops off. For homes priced over $1 million in Austin, the absorption rate falls significantly to just 14%.
Only 14%.
Yeah. So this really emphasizes the nuance within the market. Even within this overall picture of moderate demand reflected by the 18% average, some segments, particularly those higher luxury tiers, are actually moving more slowly than some of the lower or mid-range price points.
Which gives you, the listener, a more granular feel for where demand is strongest and maybe where it's lagging a bit.
Exactly. Helps you understand the specific competitive landscape for the type of home you're looking at, or maybe the one you're trying to sell.
That granular detail is super helpful. Okay, let's shift to another indicator, one that's considered more of a leading indicator, giving us a real-time pulse on market velocity. That's the new listing to pending ratio. This sounds like it tells us how quickly homes are going from just listed to actually being under contract.
That's exactly what it does. The new listing to pending ratio compares the number of brand new active listings that hit the market in a period to the number of listings that went pending or under contract during that same period.
So it's like tracking the inflow versus the outflow in real time?
Precisely. It's a true real-time pulse on market velocity, which makes it a valuable forward-looking indicator. Think of it like a busy restaurant again. This ratio compares how many new customers walk in the door versus how many tables actually get seated and place an order quickly.
Okay, so how do you interpret the ratio? What's low mean? What's high mean?
Generally, a low ratio, say below 2, suggests a seller's market with very high demand. It means new listings are getting snapped up quickly almost as soon as they appear on the menu, so to speak.
Right.
A high ratio, maybe greater than 3, indicates a buyer's market with excess supply. New listings are piling up faster than they're going under contract, like customers waiting a long time for tables because the kitchen can't keep up.
And what's considered kind of average or normal historically?
The historical average for this ratio was around 0.81.
Okay, 0.81. So where are we right now in Austin regarding this key indicator? What are the current ratios telling us about that flow?
Okay, so the monthly new listing to pending ratio is currently 0.66.
0.6.
And the weekly ratio, which is even more current, is 0.57.
Okay, so 0.66 and 0.57. Those numbers are actually below the historical average of 0.81 and way below that seller's market threshold of 2. Doesn't that seem to suggest a relatively fast-moving market, like listings are getting absorbed quickly?
That's where you have to be careful and look a little deeper. While those ratios themselves might seem low, it's absolutely crucial to also look at the difference between the number of new listings and the number of pending listings, the absolute gap.
Okay, the gap between new supply and new contracts. What was that difference for June?
For June, the difference was 1,843 more new listings than pending sales.
1,800 more listings than sales in just 1 month. How does that compare?
That represents a significant 19.5% increase in that gap compared to last year. And maybe even more strikingly, it's a staggering 82.6% above the historical average difference.
Wow. Okay, that difference number seems huge then. Forget the ratio for a second. Break down what that widening gap truly signifies for the market's health and where inventory levels are headed.
This difference, this gap, is the real kicker here. It means that significantly more new listings are consistently coming onto the market each month that are actually going under contract.
Gotcha.
This isn't just a minor imbalance. This widening gap is the direct engine driving those rising overall inventory levels that you're seeing across Austin.
It's the fuel for the inventory fire.
Exactly. It's like that restaurant analogy again. New customers, listings, are arriving much faster than tables are being cleared and seated, pending sales.
Oops.
This growing backlog, this excess, isn't just a blip. It's the consistent reason why our total inventory is climbing.
And that directly translates to?
Directly contributes to increasing buyer leverage, longer average days on market for sellers, and more pressure on sellers to price competitively. It's a key factor explaining why we're seeing this shift towards buyers.
That makes perfect sense. It's not just the ratio, but the volume difference. Okay, to wrap up this segment on market health indicators, are there any other broader, maybe composite market health metrics or indices out there that reinforce this overall picture? Do they all point the same way?
Yes, absolutely. There are a couple powerful composite scores that synthesize multiple factors, and they align perfectly with this narrative, really underscoring the market's trajectory.
Like what?
First, there's the Demand Momentum Index, or DMI. That's currently sitting at negative 23.36%.
Negative 23%. What does that signify?
To interpret the DMI, a range between negative 20% and negative 50% signifies moderate bearish momentum.
Bearish momentum.
Yeah, which is a clear technical indicator that a buyer's market is actively developing and likely gaining strength. It means demand is losing steam relative to supply.
Okay, that's one. What else?
Then there's a Balanced Market Health Score, or BMHS. That's currently at 19.2% for June 2025.
19.2%. How do we read that one? Is low good or bad?
For the BMHS, a low score, specifically anything below 30%, strongly favors buyers. It signals slower overall market activity and more available inventory sitting around.
And what's the historical average for that score?
The historical average for the BMHS is 35.27%. So our current reading of 19.2% is significantly below that historical norm, indicating a much cooler market than average.
So both the DMI and the BMHS, these composite scores that kind of blend multiple factors,
Right.
They both align perfectly with this whole narrative of a market that has firmly shifted to favor buyers, with demand cooling off relative to the supply coming on.
Perfectly. There are strong, pretty unequivocal indicators from our sources that these buyer-friendly conditions we've been discussing aren't just anecdotal observations. They're well-established trends, deeply rooted in the current comprehensive data. The numbers are all telling a very consistent story.
Those are powerful metrics that really seem to nail down the definitive shift happening in Austin's market right now.
Mm-hmm.
Okay, so we've looked at Austin City, we've looked at the broader MLS area. Let's expand out even further now and consider the regional nuances. Is this market shift we're seeing, this correction, is it just an Austin thing? Or is it happening across Central Texas, affecting our neighboring cities and communities too?
Oh, it's definitely a broader Central Texas phenomenon. Our data, which covers the whole region served by the MLS, indicates pretty clearly that these market shifts aren't isolated just to Austin itself.
So what are we seeing elsewhere?
We're seeing a widespread adjustment. Most areas across Central Texas are still firmly in a significant price correction phase, meaning prices are generally trending downward from their peaks, or maybe, at best, just staying flat. It's not just Austin cooling off.
Can you give us some concrete examples? What about average sold price changes year over year for some of these other Central Texas cities? How do they stack up against Austin's numbers and really illustrate this regional correction?
Sure. The numbers paint a pretty clear picture of a widespread correction. Many cities are showing significant negative year-over-year appreciation in their average sold prices.
Like who?
Okay, for instance, Marble Falls is down a substantial 21.3% year-over-year in average sold price.
Wow, 21%.
Yeah. Lago Vista mirrors that drop exactly, also down 21.3%. San Marcos is down 10.9%. Even Austin itself, when you look at its overall average sold price across all property types, is technically down 9.1% year-over-year by that measure.
Okay. What about some of the bigger suburbs closer in?
Round Rock is down 5.6% year-over-year in average sold price. Leander is down 3.9%. So you see this widespread pattern of negative year-over-year price changes. It indicates a collective adjustment across the entire region, not just an Austin-specific event.
Which really underscores that sellers pretty much everywhere in Central Texas need to be aware of these localized corrections when they're setting their price.
Absolutely. Local conditions matter immensely right now.
Okay, that's the resale market. What about new construction specifically? Are the builders, the developers, are they adjusting their pricing strategies in response to this more buyer-friendly market, or are they trying to hold the line?
Oh, they are absolutely adjusting. And quite significantly in many cases, when we look specifically at new construction active listings across the entire MLS, the data shows that a striking 52.6%, more than half of these new build listings, have already seen price drops.
Over half of active new builds have had their prices cut.
That's right, which is a very direct indication that builders are actively trying to stimulate demand and move their inventory in what's become a much more competitive environment for them too.
What about the rest?
About 39.2% had no price change recently, and only a very small fraction, just 8.2%, actually saw price increases. So the overwhelming trend for new construction is price stability or price cuts.
That clearly shows builders are adapting, reacting to the changing buyer mood and the increased competition, especially from the resale market.
No doubt about it. They have inventory they need to move.
Are there any interesting city variations in that new construction price activity? Because it's often where the new supply is hitting the market that we see the most immediate reactions.
Yeah, the variations by city are quite telling, actually. For example, right here in Austin, 54.9% of the active new construction listings saw price drops. That's even higher than the overall average, reflecting maybe that intensified competition within the city limits we talked about earlier.
Okay, what about other areas?
Look at Buda, 30.8% of new builds there saw price drops. In Manor, it was 45.5% with price drops. So you see widespread adjustments in these growing suburban areas too.
Anywhere bucking the trend.
Interestingly, Cedar Park stands out a bit. According to this data, 15.0% of new construction listings there actually saw price increases.
Price increases in Cedar Park new builds. Why might that be?
It could point to some localized pockets of maybe stronger resilience or continued high demand in certain parts of Cedar Park. Perhaps in specific school districts, maybe unique amenities, certain types of housing that are still commanding a premium, even while the broader market corrects around them.
So again, it really emphasizes that while the overall market trend is correction, the specific impact really varies, not just by city, but probably by property type, builder, even specific neighborhood, which gives you, the listener, that more granular understanding you need to find opportunities or set expectations.
Exactly. It's all about understanding the nuances of the specific segment you're interested in.
Okay, this granular detail is exactly what makes these deep dives so valuable, I think, for navigating such a complex market. Now, let's shift gears slightly. Even with all these market shifts, the rising inventory, the price corrections, the move towards a more buyer-friendly environment, let's address the elephant that's still very much in the room, dominating so many conversations. Affordability.
Ah, yes, affordability.
The cost of actually owning a home in Austin, even with these adjustments, it still remains a very significant financial commitment compared to renting, doesn't it?
It absolutely is, and that continues to pose ongoing, really substantial affordability challenges for a huge number of residents, regardless of these other market shifts.
It's a critical point, right? It needs to be considered alongside the inventory and price news.
Absolutely. Because while there might be more homes to choose from now, that financial barrier to entry, the actual cost of buying and holding a home in Austin, is still formidable for a large segment of the population. We can't ignore that reality.
So let's get practical. What does this all mean for your wallet, specifically for someone out there who's maybe weighing that classic Austin dilemma, buy versus rent? Can you break down the median costs right now for buying versus renting? Illustrate that discrepancy.
Yeah, the numbers reveal a pretty stark contrast right now. Let's look at the median PITI. That's your typical all-inclusive monthly mortgage payment, principal, interest, taxes, and insurance.
Okay, the median PITI is?
Currently, it's $3,412 per month.
$3,412. Okay, how does that compare to rent?
Compare that to the current median rent in Austin, which is $2,200 per month.
Okay, $3,412 to own versus $2,200 to rent at the median. That's a big gap.
That's a very significant gap. It gives us what we call a PITI to rent ratio of 1.55, meaning the median mortgage payment is 1.55 times or 55% higher than the median rent payment. And that substantial gap really illustrates why many people, even those who might desire home ownership, are still choosing to rent in this environment. It's just much cheaper month to month right now.
And what about affordability relative to income?
Well, look at it this way. Currently, about 24.44% of the median household income in Austin goes towards paying the median rent. That's generally considered a pretty manageable percentage for housing costs, right? Leaves room for other expenses, savings.
Sure, under 30% is often the benchmark.
Right, but that figure changes dramatically when you look at home ownership at the median price with current rates. The percentage of income needed for the median PITI is much, much higher.
Okay, that PITI to rent ratio is stark. How does this translate into overall affordability across the map? You mentioned analyzing Central Texas ZIP codes. How widespread is this affordability challenge?
We looked at 75 Central Texas ZIT codes, analyzing affordability based on the percentage of the median household income in that ZIP code needed to cover the median PITI for homes listed there. The breakdown is, well, it's pretty revealing and paints a challenging picture.
How many were affordable?
Okay, out of 75 ZIP codes analyzed, only just two, are considered affordable. That means requiring 0.35% of the median income for PITI. So finding truly affordable homeownership is extremely rare.
Only 2 out of 75. Wow. What about moderately affordable?
We found 28 ZIP codes fall under the moderately affordable category. That's defined as needing 35% to 50% of the median income for PITI. So while technically possible, it still means a very significant portion of the household budget is going just towards the mortgage payment.
Okay, so that leaves
a staggering 45 ZIP codes, the majority classified as unaffordable. In these areas, the median PITI payment consumes over 50% of the median household income for that ZIP code.
over half the income just for the basic mortgage, taxes, and insurance.
Exactly. Which highlights the widespread nature of this affordability crisis, even with the market corrections we've been discussing. Prices might have come down 15% from the peak, but for many, ownership is still financially out of reach or extremely burdensome.
That is a tough reality for a lot of prospective homeowners in Central Texas. Can you give us a tangible example? Maybe pick a specific ZIP code, run the numbers, just to really drive that point home and illustrate the financial squeeze.
Sure. Let's take ZIP code 78730 in West Austin. It's an area known for beautiful properties, great schools, nice amenities.
Okay.
The median growth household income in 78730 is pretty high. It's $122,243.
Okay, over 120K median income? Sounds pretty good.
It does. However, the median active list price for homes in that same ZIP code right now leads to an estimated monthly PITI payment of, wait for it, $10,519.
$10,000 a month for the mortgage payment.
$10,519 per month. And here's the kicker. That single payment consumes an astounding 103.3% of that $122,000 median income.
Over 100%. How is that even possible?
Well, it just means it's completely unaffordable for anyone earning the median income in that area. Obviously, people buying there earn significantly more or have substantial other assets, but it illustrates the extreme disconnect for the median resident. It's highly unaffordable by any standard definition.
Okay, that's an extreme example. What about one of those moderately affordable zones?
Let's look at 78748 in South Austin. That falls into our moderately affordable category. The median household income there is $86,678. Okay. The median PITI payment for homes listed in 70 to 748 consumes 43.4% of that median income.
43%, so still well above that 30% benchmark, even in a moderately affordable area.
Exactly. While it's not over 100%, like 78730, dedicating 43.4% of your gross income just to PITI is still a substantial financial commitment. It leaves much less room for utilities, food, transportation, childcare, savings, everything else.
So the bottom line here seems to be, well, yes, there's more inventory, maybe more choices, even some price adjustments happening. That financial barrier to entry for actually owning a home in Austin remains substantial for many people.
It absolutely does.
And this is a critical factor for you, the listener, to really consider when you're evaluating whether to buy or continue renting. It's not just about finding a house you like or even getting an offer accepted. It's about whether the long-term financial commitment is genuinely feasible and sustainable for your specific situation.
Exactly. It's a crucial piece of the personal decision-making puzzle. And honestly, it's a major factor shaping the demographics, the growth patterns, and maybe even the future character of Austin itself.
Okay, let's try and bring all these threads together now. Let's look at the broader market outlook and what some strategic considerations might be for you, whether you're actively buying, thinking of selling, or maybe just observing this whole situation unfold. It really sounds like Austin isn't just going through a minor blip or a small pullback. You used the word correction earlier. Is that the right way to frame what's happening?
Yes. Based on all the data we've reviewed and the standard definitions used in real estate analysis, the current market behavior in Austin aligns very precisely with the definition of a real estate market correction.
Okay, define that for us. What distinguishes a correction from just a dip or from something worse, like a crash?
A market correction is generally understood as a cyclical event in the market. It's typically characterized by a price drop from the recent peak of somewhere between 10% and 20%.
Okay, 10 to 20% down. How long does it usually last?
The decline phase itself usually lasts somewhere between 1 to 2 years. And then that's typically followed by a recovery period where prices stabilize and start to gradually climb back, which might take another 2 to 4 years. So it's a significant rebalancing, a recalibration, but it's generally not considered a catastrophic collapse or a crash, which usually implies much steeper, faster drops, often driven by widespread financial distress.
And Austin fits neatly into that 10-20% correction definition right now.
It fits squarely within it, yes. As we noted earlier, the Austin Round Rock Georgetown metro area is currently down 15.0% from its peak back in May 2022.
Right in the middle of that 10-20% range.
Exactly. Both in terms of the magnitude of the price drop so far and the duration. We're just over 2 years past that peak now, fitting within that expected time frame.
And what's the overall risk assessment for the market based on this?
Our current risk assessment, based on the composite indicators, is moderate risk.
Moderate risk, meaning it's adjusting, but not necessarily spiraling.
Precisely. It acknowledges the downward pressures and the buyer's market conditions, but it doesn't suggest an imminent or uncontrolled crash.
What specific indicators feed into that moderate risk assessment? How do the metrics we've discussed today contribute to that label?
Several key factors contribute. That new listing to pending ratio we talked about, it's currently 0.66. That falls right within the range of 0.60 to 1.0 that typically signals moderate risk, meaning new supply is outpacing demand, but in a somewhat measured, not chaotic way. We're seeing those consistent price declines, but they're staying within that 10-20% correction band, not accelerating uncontrollably downwards. The duration of this decline, being just over 2 years, is also right within that typical 1-2 year correction window.
What about sales volume?
Sales volume fluctuates, of course, but we haven't seen drastic panic-inducing collapses in transaction volume. And the broader economic conditions, while certainly mixed and showing some slowing, aren't indicative of a full-blown deep recession at this moment. So all these indicators, taken together, align with that moderate risk assessment. It points to a market that's definitely cooling, correcting, finding its new equilibrium after an unsustainable boom, but not necessarily falling off a cliff.
Okay, so looking ahead then, based on this comprehensive analysis, what's the reasonable future outlook? What can we maybe conclude about the market's trajectory from here? Is the correction over, or is there more to come?
Based on the current analysis, the trajectory of the key indicators, and maybe historical patterns for similar market corrections, it's reasonable to conclude that the market might still have a bit further to correct.
How much further?
Our sources suggest it's plausible the market could correct an additional, say, 9.28% from current levels. That translates to roughly another $41,000 off the median price, potentially.
Okay, so maybe bottoming out around 24-25% down from the absolute peak.
That's one plausible scenario based on this analysis, yes. Again, this isn't a prediction of a crash, but more like the continued gradual unwinding of that previous, frankly unsustainable growth we saw.
And how long might this buyer-friendly environment last?
Forecasts from the sources we're looking at suggest that buyers are likely to maintain this newfound leverage, this advantage, probably through 2026.
Through 2026, so potentially another year and a half or so of these conditions.
That seems to be the prevailing forecast, yes. Which means this isn't just a brief window, it's potentially an extended period of correction and rebalancing. And that offers a significant, prolonged time frame for people to make strategic decisions, whether buying or selling, with maybe more foresight and less panic than during the peak frenzy.
Okay, that brings us right to the actionable insights. Let's start with buyers. Given this outlook, a moderate risk correction likely continuing through 2026, this sounds like it really could be a golden opportunity, maybe a real moment to capitalize on the market's rebalancing. What should their next steps be? How can they best leverage these conditions?
For buyers, yes, this environment truly presents a significant opportunity, maybe one we haven't seen in Austin for, well, maybe a decade or more.
So what should they do?
First, recognize you have more negotiating power. Don't be afraid to make reasonable offers that reflect this new market reality. Feel empowered to include contingencies that protect you. Things like detailed inspections, appraisal contingencies, financing contingencies. Maybe even ask for seller concessions like closing cost credits or funds for a mortgage rate buy-down. These are all back on the table now.
What about searching?
Focus your search strategically. Look closely at those areas and price points like we discussed. Maybe that $500K to $600K range within Austin proper seems particularly pressured right now, where the data shows pricing pressure is most evident, where median prices are softening.
And be thorough.
Absolutely. Be diligent. Understand the full cost of ownership, not just the list price. Factor in current mortgage rates, property taxes, insurance. Get a clear picture of your total PITI payment and make sure it fits your budget comfortably. Explore different financing options, maybe look at adjustable rate mortgages if appropriate for your situation, or negotiate those seller-paid buy-downs. And most importantly, be patient. Take your time to find the right property that truly meets your needs and your long-term financial goals. This is a market where patience and thorough due diligence can yield substantial rewards, unlike the rushed decisions of the peak.
Okay, great advice for buyers. Now for sellers. It seems like they need to fundamentally recalibrate their approach, really shed those expectations left over from the red-hot market of a couple years ago. What's the strategy for them?
Absolutely. Critical recalibration is needed for sellers. The market unequivocally requires a much more realistic and strategic approach now.
What's the number one thing?
Pricing. You will face increased competition. Strategic pricing, right from the outset, is absolutely crucial. We're already seeing over half of new construction listings with price drops, right? So understand that setting an aggressive, competitive initial price can actually save you considerable time on market and potentially prevent the need for larger multiple price reductions later on, which can stigmatize a property.
So don't overprice hoping to get lucky.
Overpricing is probably the single biggest mistake a seller can make in this market right now. Be prepared for potentially longer days on market compared to the peak years. Be prepared for offers that might be less aggressive, maybe include more contingencies. It's just the reality.
What about presentation?
Presentation is paramount. Professional staging, high-quality photography, effective online marketing, these are no longer optional nice-to-haves. They are necessities to make your home stand out from the crowd.
And know your local numbers.
Yes. Understand your specific neighborhood's absorption rate, the current months of inventory for similar homes. This local data is essential for setting realistic expectations about timing and pricing your home effectively to actually sell within a reasonable time frame. This market demands a proactive, data-driven selling strategy, not wishful thinking based on 2021 comps.
Before we wrap up, are there any interesting industry trends happening that kind of reflect this broader market contraction, maybe within the real estate profession itself?
Yes, actually there's a telling industry trend that mirrors what's happening in the market. It's worth noting that the number of licensed realtors who are members of the Austin MLS has actually declined.
Oh, really? By how much?
It's currently at 18,587 agents. That's down 12.64% from its peak, which was 21,276 agents back in September 2022.
Down over 12%. That's quite a drop in the number of active agents.
It is. And it's not just a minor fluctuation. It directly reflects the broader market contraction. It likely indicates some consolidation happening within the real estate profession itself, as maybe less experienced or part-time agents exit the business now that the market is less frenzied and more competitive. It suggests that experience, local expertise, and strategic insight are becoming paramount again.
A powerful reflection of the market's shift right within the industry itself.
Yeah. Okay, so as Austin's real estate market continues this really significant recalibration, we've seen clearly today how it's moved into what you're defining as a definite correction phase. And I think the crucial takeaway for you, the listener, isn't just about memorizing all these specific numbers, but really about recognizing this fundamental shift is happening and understanding what it actually means for your own strategic decision-making.
Yeah, we've really gone from that frantic sprint of a couple years ago to a much more measured, thoughtful pace today. We've seen inventory definitively rise, median prices softening, especially in those key middle tiers, and buyers are systematically gaining leverage back. We've seen that pronounced shift to a buyer-favorable market driven by that rising inventory. We've seen the really nuanced split in pricing trends, especially within Austin's core, high-end, maybe stable, but the middle softening. And we've seen these broad regional price corrections affecting pretty much all of Central Texas.
Right. These aren't just minor adjustments on the margins. They feel like fundamental realignments that are actively reshaping the character and maybe the accessibility of Austin's housing landscape going forward.
So the final thought for you to ponder as this market kind of takes a deep breath, right? It's allowing for more thoughtful engagement, less impulsive reaction. What new possibilities does that open up for you in your own real estate journey? And maybe stepping back, how might this sustained period of correction, potentially lasting through 2026, how might that ultimately shape the long-term character and maybe even the accessibility of living in Austin? Perhaps it leads to a more sustainable, less volatile market for the future. Something to think about.
Absolutely. We really encourage you to use this newfound, hopefully more granular understanding to inform whatever your next steps are, whether that's doing deeper research into specific zip codes that interest you, or engaging with trusted professionals who really understand these local nuances.
Or maybe just observing the market trends as they continue to unfold, but doing so with a much more informed and confident perspective now.
Stay informed, stay strategic, and just remember that in any market, but especially a shifting one like this, Knowledge really is power. The insights you've gained today hopefully empower you to make smarter, more deliberate choices in this evolving Austin real estate landscape.